Hi, this is Chris Westfall, and this is the Risky Science Podcast. In this week's episode, we're digging into the California insurance market, and specifically into the fight over who actually owns wildfire risk. Is it the insurers pulling back from high-risk areas, the utilities whose equipment sparks some of the fires, or the ratepayers and taxpayers left holding the bag when the bill comes due? To help sort through it, I sat down with California State Senator Ben Allen, who's running for insurance commissioner in the state. We get into reinsurance costs, catastrophe models, the FAIR plan, capital requirements, and where the state's private market approach diverges from the public alternative his opponent is proposing. Two quick notes before we get into it. I've reached out to Senator Allen's opponent in the fall election, Jane Kim, and I'm speaking with her staff about setting up our own discussion on the podcast. Also, and if you'd rather watch than listen, the video version of this podcast is now live on YouTube. A link to it is in the episode show notes. Check it out and subscribe there. Hope you enjoy the conversation. Senator Allen, thanks a lot for taking the time, especially coming across a holiday weekend. I'm sure you're pretty busy with everything going on.
It is wild.
Yeah, I can imagine. It's amazing you made the time, so I really appreciate it. But California, its insurance market, it's constraints as far as electricity demand and the infrastructure is something we revisit on a constant basis, on the podcast on the site. And with the California Insurance Commissioner election coming up, it was great to have a conversation with you about your thoughts on that. And I like to sort of start broad and then get to sort of more specifics. So maybe we could start with a sort of a level setting question, and that gets to what I just mentioned. So California, in my mind, it's become a real test case for what's happening, across the U.S. and probably the world in terms of, physical risk and how it's colliding with all these different facets in the market, like electricity demand. Now you have AI data center demand coming up, and then you have on the back of it, you have really increased insurance rates and reinsurers getting a lot more thoughtful about the catastrophe, coverage they do, right? So, what just from a broad perspective, how do you think about those tensions and what's happening in California, and where does that cost of that risk actually end up sitting in your mind?
Yeah. I guess I'd say so. It feels as though the state's dealing with a whole slew of different pressures all at once. We've got climate risk, of course, that continue to rise. A lot of infrastructural risks and challenges. A creaking system that has been underinvested in many respects. And then, of course, all this growing electricity demand from data centers and from electrification. The core point is that risk doesn't disappear; it gets allocated, right?
Right.
So if we don't reduce the underlying risk, the cost shows up in utility rates and insurance premiums, cost of the FAIR plan, disaster spending by the taxpayer, underinsured families, public health costs, et cetera. Right. So now, I part of my kind of central pitch, I suppose, is that. As to why I'm the right guy for this job is the insurance commissioner can't look at insurance in isolation. We need somebody who actually understands the big picture and has worked on a lot of different issues in public policy, from energy to wildlands management and to zoning and housing and risk reduction investments, both at the individual level and the community level, et cetera. But obviously, we need accurate risk pricing. We need stronger consumer protections from my perspective. We need faster risk reduction through home hardening and defensible space and community mitigation, grid hardening, better planning. all those kinds of things. Um, I think with utilities, we don't want to double count or blur liability systems.
Right.
But if grid hardening or undergrounding measurably lowers wildfire risk, I think that insurance models should recognize that. I mean, at the end of the day, it's about, I think the cheapest wildfire loss is the one that never happens, right?
Yeah.
And a stable market depends on reducing the actual physical risk. And my grand vision, I think what gets me most excited about running for this position, quite frankly, is to see what we can do to really push both in culture and law and code toward a system that's much more focused on risk reduction, and have that both be incentivized and pushed along and rewarded by our insurance system.
So how do you? I guess my question is, how do you do that? From I mean, like the insurance commissioner is a very like specific remit in a lot of ways. It deals with rates and things. How does that flow down to, for lack of a better term, enforcing mitigation?
Yeah. So I think one of the challenges I find when I'm going out there into very high fire risk zones uh, is when you're talking to city elected officials. They're doing all this work to try um, to reduce risk, to create more firewise communities, and they're not able to get calls back from the insurance companies. And I
Mm.
really see part of my job as insurance commissioner to push for a greater engagement by the insurance companies on this issue. They talk a lot about how they want to see more risk reduction, and I have no doubt that in a perfect world they would want to see more risk reduction. But I want to see them be part of the solution. I want to see them at the table, engaging with local governments, engaging with fire experts and the builders and environmental folks and everybody together to come up with a set of models that are going to be that are going to really tangibly result in risk reduction, that will actually at the same time be reward that risk reduction work. I don't think that we can demand of the insurance industry that they have to cover all high risk areas in the state without us putting in any real investment or focus on risk reduction. The
Right.
flip side is I don't think we can ask communities or individuals to do risk reduction work if they don't feel confident that there's going to be more affordable, more available insurance on the back end, because that's at the end of the day, that affordable insurance is going to be what I think is going to have to drive motivation and incentive for us to do this risk reduction work.
Yeah, and that's something I've seen mentioned a couple of times on the consumer side, that they've done the mitigation. They don't necessarily see it in rate sometimes, but
Right.
you know, the other, sort of just tying together. If I understand it correctly, you have a fire mitigation partnership bill that sort of like
Yeah.
brings utilities and insurers on the same table. But if I understand correctly, there's already the utilities have their own wildfire liability backstop. With recent legislation, that's paid through ratepayers and shareholders. That's separate from how homeowners insurance price utility cause ignition risk. How should how do you figure that into the whole concept of grid hardening and undergrounding cables and things of that nature?
Yeah. Well, let me just start by, I want to caveat that I've been involved with this working group that's examining this very intersection, and I don't want to get ahead of our work and the recommendations that are coming together. But the kind of framework that I'm thinking about as a potential insurance commissioner is to keep the systems legally distinct but not blind to each other.
Mm.
AB 1054, this big fund that's paid for by ratepayers and shareholders, the liability backstop, is about utility liability and grid stability.
Yeah.
Insurance rate review is about whether homeowner premiums are fair, transparent, actuarially justified. So so I don't want to see utilities shift responsibility in a way that's going to in a way that just kind of involves squeezing the balloon and having the issue pop out somewhere else.
Right.
I don't want to let insurers double count risk. Certainly, I don't want to confuse utility liability with homeowner rate review.
Yeah.
But if a utility's wildfire mitigation measurably reduces ignition risk, and models and filings should be able to reflect that. So bottom line, I mean, I want to keep the system separate, but I do I want to recognize and reward and incentivize real verifiable risk reduction. And I also am aware. I mean, what's really interesting about my current role is that I'm the chair of the Energy Utilities Committee, and I'm also
Mhm.
running for insurance commissioner. So
Right. Right.
I walk back and forth between energy world and um, and the insurance world all the time, and the two sides don't really understand each other. Actually, I mean,
Right.
or at least, or let me put it this way: of course, they prioritize different things. And so, from a utility perspective, everybody is focused on what we can do to try to reduce rates
Right.
and affordability and reliability and grid resiliency and all of that. On the insurance side, it's about availability, affordability. Uh, so, um, but each side is so perfectly happy to let the other side, take on much more cost and risk associated with all these problems, and forgetting the fact that the real reason why we want to fix both of these problems is to reduce cost of living for all
Right.
Californians who are paying for both electricity, energy, and insurance. So just robbing Peter to pay Paul is not the solution here either.
Yeah. Do you
And
think
I
there's a
say that to my friends on both sides who want to just point the finger to the other one and let the other one handle it all.
Yeah, and I do get that, and I say, do you think there's a fair amount of scapegoating on both sides in the markets when it comes to?
I mean, yeah, a ton actually. I mean, and it's not always very. It's not even unpleasant scapegoating. It's
Right.
almost. It's almost. It's so built into the way of thinking because everyone's so focused. Everyone sees the world through the pair of glasses they put on every morning from based on where they work and live, and
Yeah.
it's not it shouldn't be some big surprise to all of us. But I get to see it up close every day as I navigate these two worlds.
Absolutely. Yeah. The one thing I'm going to touch on is the reinsurance sector, and not
Yeah.
everybody is like totally up to speed on the reinsurance sector and what it does, but you know, but your if I understand correctly, your thought is that like insurers should be able to include reinsurance costs in the rate filings, but there's always this like push and pull again to the previous comment about like where are these costs coming from, how are they determined. So what oversight would you put around that sort of pushing those reinsurance costs down? Is it like bidding, is it benchmarking, what's the how do you propose to do that?
Yeah, no, great question. I mean, look, reinsurance is definitely a real cost of writing catastrophic risk in California. And I think if we totally ignore the cost, capital, it will impact capital markets. And I think,
Right.
and that then impacts homeowners having real options for insurance. I certainly don't want to see, however, reinsurance being, the the inclusion of reinsurance in the calculation to be some sort of blank check.
Right.
Um, I think you got to have so you need real oversight, right? We need competitive placement, panel diversification, benchmarking against market pricing, um, review of affiliated transactions, allocation tied to actual California exposure, uh, auditability. I do think also one of my Republican primary opponents has a whole idea for greater. He didn't end up winning, but I'm really very intrigued by this proposal called Cal Reinsure, which was to say that we should consider having the state have a very targeted, limited but incisive role in the reinsurance market that could help to smooth over some of these market rigid, market dysfunction that we're seeing right now in the global reinsurance market as it interacts and reacts to California's risks. Um, but bottom line on this question, I think would be just allow for justified reinsurance costs, but also require transparency and benchmarking and auditability as we look into maybe a greater state role in this area.
So you're thinking like, is that concept around like, I guess, like a tria, but for wildfire? Would that be a way to put
Yeah,
it?
I think this is still in early kind of conceptual stages, but I would encourage take a look at what Merritt Farron put out there with regards to what's called Cal Reinsurer, is how he described it. But basically, there may be a state-backed tranche
Mm,
of reinsurance that would serve the market. We'd have to find where is it in the reinsurance spectrum
right.
that that the state is being most screwed with regards to um, costs that are impacting availability and affordability, and maybe we get the state involved there to fill in that gap, and allow for the market to work better.
Yeah, if there's nothing reinsurer, especially London reinsurer, likes talking about more, it's where the layer sits. So I'm sure we'll
Yeah,
have a lot
it's
of
all
conversation.
stacked, right? So
Yeah,
exactly. So where's the greatest inefficiency right now? Where's the greatest dysfunction happening? And how do we use the power of the state to and the resources of the state to fill in that gap? And it could, if done carefully, and again, I want it to be limited and careful, but if done carefully, we could actually do ourselves a massive favor without creating significant new liabilities.
the other topic I cover a lot is around modeling because that informs price, it informs availability, and if I understand correctly, and I've done a little bit of work about this, about like you support a state-run public catastrophe model similar to what they do in Florida, but for hurricane risk, sort of
Yeah,
benchmark vendor models, and but those models, the existing commercial models, the reinsurers, insurers already rely on them. So if your state model, what's your thought around modeling, and what if there's a large disagreement between what the state model is showing and what the commercial models are showing? How do
yeah,
you
that's a
how do
great
you overcome
that
that?
Yeah, that's a great question. We actually passed legislation last year to create a public model that I, was involved with and certainly supported. I think a public catastrophe model should be a benchmark. It's not a political substitute for private models.
Right,
The private models matter because reinsurers and rating agencies and capital markets use them. But California shouldn't just blindly accept black box assumptions. I mean, if the you know especially when those private models are being developed for profit companies whose job it is to maximize shareholder benefit as opposed
right,
to benefiting the public, right?
right.
So that's why we got to that's actually why I think there's benefit in the public model, with the public model. um, Now, if there's a major discrepancy, I think the Department of Insurance needs to ask why. All right, but
Mm-hmm.
is it vegetation, ember risk, utility ignition risk, mitigation, climate assumptions, rebuilding costs? Is it the community disaster response plans that are maybe considered inadequate? No model I think should automatically win,
Mm-hmm.
um, but you want the commissioner to be making evidence-based decisions based on the full record, really incorporating all of the different concerns. And but there's real value to a public model that could help to test assumptions and improve transparency. And I think that's my vision for the role that the public model ought to play going forward in this area.
What about one of the criticisms of a public model is always, I think I've gotten this right. People say it's a speed to market issue. Like the commercial models already exist, and by time you develop a public model that's tested and verifiable and is accepted, a lot can happen. What's your thought on that?
I think you have to just keep them updated, just like the private models have to keep updated. You don't just create it once, and you have to recognize that we're operating within a world of ambiguity and change.
Mm-hmm.
And again, it's why I say that um, that I wouldn't. I'm not always going to err on the side of the public model, because
Right.
I just think the public model, which again we're going to have to keep updating and engaging and testing and provoking and prodding and asking to improve, just like we want a private model to do. Um, but having a model out there that is drafted by and driven by experts who do not have a financial interest in a particular
Mhm.
set of insurance outcomes, industry outcomes, is just a good thing in terms of testing assumptions and transparency, improving transparency.
Yeah, that makes sense. I want to, there's so many. I guess it's kind of a third rail, but like there's nothing but third rails when it comes to these issues, it seems. But several carriers have sort of left California, pulled out over the past several years, and when you think about that and solvency risk, what do you think about that in terms of like the current capital and surplus requirements that are needed to keep carriers in, or do you think that what do you think about that retreat? Is it How do you address it? How do you encourage carriers to come back in while also like addressing some of the criticisms of the carriers from the consumer side?
Yeah. So you're talking about sort of capital adequacy and
Yeah.
its interact. Yeah. I mean, obviously, when it comes to capital adequacy, I mean, claims paying capacity is non-negotiable, right? That's
Right.
really important. I mean, consumers need to know that their insurer can pay after a disaster. Of course, capital has choices, right? I mean, if California is unpredictable or underprices risk too much, carriers are going to reduce exposure. They're going to leave. So, I don't think that capital requirements per se are the main problem. I think the bigger issues are things like wildfire loss and reinsurance costs and rebuilding inflation and regulatory delay and uncertainty over risk-based rates. And
Mm.
so I don't know that it's about weakening solvency oversight. It's more about trying to help make the market more predictable, more timely, more transparent.
On the other side of that is the fair plan, right? And then the fair plan like has grown and needed $1 billion, just to pay claims, and enrollment goes like hundreds of percent. What do you think about that from a state and concentration risk issue? What's your thoughts on the fair plan?
Yeah, well, the fair plan, I mean, the current trajectory is just not sustainable. I mean, it's totally oversubscribed, undercapitalized, never designed for this kind of portfolio. I mean, it was designed, as a temporary market of last resort, not a long-term insurer for hundreds of thousands of Californians.
Right.
And in some respects, all the growth that we've seen in the fair plan really shows how unhealthy the market is in some respects. The admitted market. And we're now seeing, of course, a lot of people turn to the surplus lines markets as well. And so, the other thing is we've got this kind of system where we assess the admitted carriers, and that creates a certain amount of system-wide concentration risk. So I think, in the long term, we need to rebuild the admitted market, create more competition, make it healthier, move people out of the fair plan, ensure the fair plan has adequate reinsurance and a sustainable assessment structure. That's really important. I mean, I certainly think that so many people rely on it now that
Right.
you got to stabilize it. But while certainly we got to make sure the fair plan's financially sound, success really means shrinking it over time.
Mm-hmm.
And I do think that on the long term, this risk reduction work that we were talking about earlier, and really getting systematic and dogged and focused on scaling risk reduction in a way that marries our insurance needs, is going to be how we restore health in the market. Along with creating some more options for competitiveness and that's got to be where the focus is. I mean, doubling down on the fair plan it's just not made to be a major market competitor. It's not what it's there for. It's there to provide like a bridge, like a band-aid for niche markets that for whatever reason are struggling to get insurance coverage at a particular moment. You know why the fair plan was first established?
No, no, why?
Yeah, it was 1968, in direct reaction to insurers pulling out of inner city communities in California after the '65 civil unrest
Mm,
and just all the problems happening around the country. And a lot of black homeowners were actually, at risk of losing their mortgages because insurers were pulling out of South LA and, you know, West Oakland and South Sacramento and all sorts of
right,
communities around the country, around the state. And it was harming, it was actually really putting at risk a lot of folks' ability to keep their mortgages in their homes. And so the state said, we got to put something together. And so they created this bare bones insurance system that would meet the very lowest kind of standard of underwriting, so that people to keep people's loans coming, and of course over time it's completely shifted in focus. It's now become a kind of a wildfire risk
right.
plan.
But it's not like it's not like you see this in other markets. Like just from my own understanding of Florida, they had citizens and they had a public backstop and they had grown to taking a majority of the policies on hurricane risk. They put together a plan that was, the theory is bringing in private carriers to take away that risk, and they made a bunch of changes. But the criticism of that is those carriers that came in were not or may not be the highest quality. So how do
Mhm.
you sort of like manage that push and pull?
You got to be so careful. You got to be so careful of that, and I think that's where um, that I mean that that's where the department's going to have to
Right,
really vet carefully. Um, and it's all about striking that balance between careful vetting so as to ensure consumer protections and viability, solvency, and you know, while also at the same time um, allowing for enough flexibility and competition that will create a virtuous cycle in terms of driving down costs. Because right
right,
now the market's a little too stultified, and it's led to the situation where you know so many people are getting dropped and they're now having to turn to the
right.
fair plan, the surplus lines, and where they're paying so much more. So clearly there's a problem. But yeah, you're right. We have to be careful not to it doesn't mean we just open the floodgates, let anybody and their mother enter the market, the admitted
Right.
market, who may not be ready or able to meet the expectations that we have in a state like California, which is where we want to make sure that the companies that are doing business here are actually legit and treat people well and are not going to leave people holding the bag.
So if I understand it correctly, you're going into election in the fall, and your opponent, you know, I think has floated a public disaster insurance fund. And you want to keep the private market. You want to attract the private market back. So, what are your thoughts on those two proposals and those two ways of thinking? What's your argument for why the private market needs to be incentivized against a public disaster fund?
Yeah. First of all, what my opponent has proposed um, doesn't exist anywhere on planet Earth,
Mm-hmm.
right? I think she's basing the idea off of what we do in healthcare, right? With single payer healthcare insurance. And so she said, well, let's do a single payer disaster insurance. Well, single payer healthcare insurance exists in a number of countries.
Mm-hmm.
Um, people don't all get sick at once, but we do have big disasters all at once where the state's massively on the hook when a big disaster hits, just already, regardless of insurance costs. I mean, the state is on the hook for infrastructural costs and firefighting and police and everything else. This huge spike in public liabilities.
Right.
Um, the the other thing is when it's also her proposal is incredibly inequitable if you think about it, right? Because if you're a poor person or a rich person and you get a terrible case of cancer, the cost of treatment is actually relatively similar, regardless of your personal wealth.
Mm-hmm.
But if you're a rich person with a very expensive house and a poor person with a very inexpensive house, and now you're going to treat them all the same from the the state's going to be on the hook for covering the cost of either property, um, you can see pretty quickly how her proposal ultimately results in a massive subsidy from poor to rich, to
Right.
areas of higher risk, to areas that are more expensive, and that's not fair or equitable. Even um, the reason why no other country does this in the world is because this is not a well vetted or thought through proposal. I mean, the closest. So she will often bring up New Zealand as the most progressive example out there. But let me tell you, New Zealand does not cover fire.
Mm-hmm.
It covers up to $167,000 per unit, which that's helpful. Don't get me wrong, that's helpful. But the average home in California is like 850,000, and of course we know there's many that are much higher.
Right.
Totally different risk profile in the country. 5 million people in the whole country. It's a national system, of course. We're a state, so there's actually no one that does what she's proposing. And as someone who served on the budget committee, who knows very well how delicate our state finances are, I am just not willing to gamble the state's fiscal solvency on a totally untested idea
Mm-hmm.
that could bankrupt the state with one major disaster. I mean, you think about the liability associated with a huge set of fires like we just saw in Los Angeles. I mean, that could devastate the state. Or we'll be spending so much money on international reinsurance that I'm not sure it would bring all the benefits that she is claiming that it will bring. Um, from my perspective, and by the way, that whole proposal will have to involve. That's not something the insurance commissioner can wave a magic wand and
Right. Right.
implement on his or her own. So, you know, what I bring to this story is someone who's got a real track record of success. Fighting for common sense reforms, taking on the industry when necessary, seeing the experience of my own constituents in the fire zone in Los Angeles and all that they went through, and advocating for them, fighting for them, running legislation to prevent people from being treated the way that some of my constituents were treated last year. Um, you know, Someone who's got a real track record of getting difficult legislation through the legislature, who's got deep relationships with the next governor, with the legislative leadership, who's got who's just focused on trying to make the system work better for working people right now, as opposed to pursuing some pie in the sky idea that I have very little chance of implementing, and that even if it sounds great, once you start to interrogate the basics, it could really I think it would be a very serious mistake, quite frankly, if implemented as she has proposed. And there's a reason why nowhere else on planet Earth, including very progressive countries that have very robust public insurance programs for healthcare, no other country has done what she's proposed. So, yeah, that's what I would say.
As I was saying, before I got rudely interrupted by the weather, one of the things that, you go into the rooms with insurance executives, and I see this all the time. They get really worked up about it's like regulation and the processes, and especially in California, in markets like California. And one of those is the intervenor process in California, and where it lets consumer groups challenge rate filings, and insurers pay the cost of that. So and it's one of the reasons they'll say is rate increases can take years. So what is your thought on that, and how do you again measure the push and pull of consumer needs and what the market needs to function?
Yeah. Yeah, look, I mean, I've certainly seen, both of them. Again, I was talking about my different hats. I mean, the intervenor process exists at the PUC, at the Public Utilities Commission, and also in the insurance world. And there are certainly some benefits to the intervenor process. I mean, it provides a kind of an independent check on rate filings for consumers. Now, I don't think that consumer advocacy should mean preserving years-long delays.
Hmm.
I think we should see clearer schedules, earlier identification of disputed issues, stricter discovery timelines, more active case management, faster resolution of technical disputes. Uh, so I want the process to be more disciplined and timely, and I certainly, I mean, from my perspective, the intervener process is there to the extent that it's actually informing the process in a way that's benefiting consumers and making sure that the decision making process is better informed. That's a good thing. If it's not, then it's not doing its job. So, from my perspective, it's about um, making sure that we're not just rubber stamping new rate increases without a really well informed process. And I think the interveners can play an important role, but but certainly consumers are not helped by delays that drive insurers out and raise costs. That create more unpredictability that can also raise costs. So from my perspective, we need accountability on every level, and speed and efficiency, and good decision making, and those would be the principles by which I'd be thinking about the intervener process and its future.
But not scuttling it altogether.
I don't see the merit in scuttling it altogether. But again, I do think, but again, that doesn't mean I'm just going to be a defender of the status quo. I really think there's a series of reforms that we ought to implement that would create more discipline and timeliness. Schedules, right? Like being proactive about identifying disputes, and more active case management, and discovery. I mean, all those sorts of things. Stricter timelines.
One thing, and this, you've been really thoughtful with your time. Really, thanks, and again, especially on holiday weekend. But getting back to that point, like measuring success, right? And what does it look, and what does change look like? So, from your perspective, and when you think about what, as a commissioner, you can measure success by, you said, if I understand, you said success looks like fewer people on the FAIR Plan, a more stable market. But what does that like? What are the metrics on that within a timeline? Like, what does that look like, on the admitted carrier side, the reinsurance side, the consumer side? How, as commissioner, would you measure the success of change?
Yeah. So yeah, I mean, obviously, I've said I want fewer people in the FAIR Plan, more admitted market policies, more carriers writing new business, faster rate filing decisions, more stable reinsurance participation, mitigation reflected in models and pricing. So right, metrics. I mean, what I think you'd look at FAIR Plan enrollment. Obviously, you look at rate review timelines. Per your earlier question, admitted carrier participation, carrier withdrawals or moratoria, reinsurance panel depth and pricing, consumer complaints, claims performance. So the goal is not artificially low rates, right? It's
Right.
more availability, more competition, more transparent pricing, stronger consumer protections, lower and most I think important for the long term solvency and stability system is lower physical risk.
Great. Those are my questions. Thanks so much for taking the time.
My pleasure. Yeah, sorry. Sorry for going on, but
No, we go on this. So it's been great.
Yeah.
Terrific. Thanks very much.